Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Thomas George of Grizzle Research. He is the portfolio manager of the DART ETF, Disruption at a Reasonable Price, and he is the former head of commodities at TD Asset Management. How you doing today?
Oh, fantastic. How are you, Darrell? Always great to connect, man.
Yes. So I want to start just by, introducing you to the audience. And you were the former head of commodities at TD Asset Management. So what was what did that job entail? Like what role did commodities play into your work there?
Yeah, so that was kind of our bread and butter. I managed the precious metals fund, I managed the resource fund, and we had an energy fund as well. So the whole gambit, and between Canada and Australia, these are the two core centers, right, of commodities, right. And Canada being having the addition of oil and gas, so it was a great setup to learn the vast industry. I worked under some of the best. I was there for over 17 years. So, you got a good lay of the land of all the pieces that come together to bring resources to life, right? And, to production. It's a process, right? And that process has only gotten longer. There are a lot more hurdles than there were, say, 15 years ago, right? And so it's a dynamic space.
Yeah, for sure. Yeah, appreciate you sharing that context with us and that history. So DARP, portfolio manager at DARP, Disruption at a Reasonable Price. So you're into commodities. I mean, you're obviously the head of commodities at TD Asset Management. And DARP has a commodities allocation within the ETF.
Correct.
And so, but it also has some tech in there. There's a big holding of, Meta, Nvidia, and some of these companies. So could you just share some of the philosophy or the approach there with the ETF?
Yeah. So, we launched this ETF just now. Well, we're coming in on our 4-year anniversary, and it was a unique strategy in the sense that myself and Scott Willis, we both managed the ETF. Our view was that very simply was that disruption's real. There's no question about that. And the lexicon, the language of disruption has always been very technology focused, right? And we're clearly seeing all that in the AI revolution today. But what's missing in the conversation and in the investment process and philosophy was an appreciation and valuation for the fact that commodities are a core component of of this story, right? They're the bedrock in a lot of ways, right? You don't get EVs, you don't get these revolutions that are happening without the physical aspect of what's powering that up. So from our perspective, our view was that disruption was myopically focused on one clear area with technology. Now, we are very overweight technology, so that's a clear area for us, and we own Nvidia and all the other AI names and size. But the other side of it is that we've owned as a barbell. So the ballast to that is that we own natural gas, we own copper, we own lithium, right? So all of the pieces that we feel are critical to powering that future, we own that in size, and also we own gold as well. We understand the monetary situation. We own Bitcoin. It's a very dynamic thing where we believe you don't need to own the mushy middle, and so you don't need to own some sleepy consumer staple company. That's not gonna move the dial for you, right? What you need to own is technology stocks that are changing the world, and you need to own the resources that are going to fuel those changes, right? And so for us, that was the bedrock of the strategy. We're closing in on 4 years. 3 years is your magic number. We built this. So, elephant in the room. Kathy Wood, I got to give her credit. She was right about the vision about disruption. We believe wrong about the execution in the way she sees it, right? Her view is like big shiny object, 10 years out in the future plus the cash flow. Our view was that just wasn't feasible, and it really opens up yourself for dramatic drawdowns, right? And we saw that she had big drawdowns in her strategy. Our view is that disruption is very real, but you got to take a view of the 4 to 6 year vision of cash flow inflection. That's the sweet spot, and you have to marry in resources because they're a huge foundational element to this piece, and that was kind of the bedrock of it. Since we've launched, we've significantly outperformed every disruptive peer, Kathy in particular. But that's we've outperformed the Nasdaq, the S&P 500. We view that this strategy is a significantly enhanced strategy to the traditional view of growth investing because it marries these two key elements.
Gotcha. So I see that the ETF is up 32% on over the last year, and it's up more than that over the past 5 years since its inception, since it's been launched. And so thinking about tech, so many of the audience may be wondering, okay, well, Nvidia, all-time high, Meta, all-time high. The market seems like it's in a bubble. Sam Altman comes out and says we're in the AI bubble and such. And so that may cause a lot of hesitancy for people to think about, like, okay, holding any weighting to any of those companies. And so what would be your defense of that? Mhm. Yeah, agreed. Yeah, and I want to dive deeper into the commodities and precious metal side of things. So, just looking at, so you mentioned Nvidia being cheap today, and I imagine that you're thinking of forward projections as well as their current capacity to, and in their current market share of producing chips and such. And so, thinking about Nvidia is currently at a 49 PE ratio, so price to earnings. So, what makes you view this company as cheap comparative to? I mean, obviously you have your future outlook and such, and in today, someone may look at the PE ratio and say Nvidia is overvalued. So what makes you say that they're cheap today?
Yeah, so that was the same argument like 3 years ago, right? Exactly. Like it's just that this is trading at like, and again, this is just on that forward. So our view again comes back to when you think about disruption. No question. You have to. It's that marriage of taking the reality of their business, which is very black and white, right? This is a very profitable business, overlaying a growth period that's not just next year, not the 2 years. You got to take a 4 to 6 year view and say, okay, where do I sit 4 to 6 years from now? And is this like stock incredibly cheap? And our view is that this is still a very attractively priced stock that is at one of the highest return on invested capitals in the entire technology stack. That that it's still in a very sweet spot. So from our perspective, looking at the 1 year, looking at trailing, never tells the full picture. You really got to take the bigger picture view about where are we in the penetration of AI. And I think anyone who's had a close interaction with AI and their workflow and their process, and everyone who uses it is using it in their own very specific workflow, right? But that workflow is going across the biotech. It's in a very large plethora of industries, and those industries are still, in our view, relatively very underpenetrated, right? And corporations are interesting, right, Darrell? Like I think about it a lot, right? I spent a lot of time at one, and the way they're built is not like how a small startup or a very cutting edge firm is built, right? They're really built to basically put the brakes on innovation, right? Like that's kind of like their inherent operating model, in the sense that you're like, I got something new, I got something great, let's put it into production. Like, whoa, slow down there, young guy. And that kind of and that's not just that permeates across corporate America, right? And so there's a cultural shift that has to happen, that is happening, obviously, but those things just take time. And I think that just really, really adds to the tailwind of, the bear case saying, well, it's not breaking through to corporate America. Corporate America is not built for AI. And here's the thing, that once they feel that these smaller, more nimble, more dynamic firms are really clipping at their feet, they're going to get religion. And it's not they're not making a U-turn on this right now. They're continuing to seep it in. So, I think we're still at the very early innings of, this big, big seeping of AI into what I consider large cap corporate America, right?
Timing is everything in this business. We've seen commodity prices really move up. The copper price, that started to move up strongly. We're not far off all-time highs, although you wouldn't know it from the junior sector and copper companies in general. But I think over the next year or two, we're going to see that really correct to the upside, and you're going to see a lot of money come into the sectors. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
Okay, and then just a couple more questions on that, then we can move on to commodities and everything. So, one, I want to talk about government investment into the AI sector.
Yep.
I mean, right now we have the AI race. People are projecting this between the U.S. and China in the AI race. I mean, Throughout history, we've had like the space race, we've had the race for nuclear arms and all type of stuff, right? And so governments come in and they spend a lot of money to invest in that. We've also had companies pledging to spend billions of dollars to build out AI infrastructure and stuff. And so, in which a lot of that has to relate to data centers and such, which we'll get into that. But there's billions of dollars, trillions of dollars that are looking at being spent in this particular sector. And so I want to touch on that.
Personally, I think we're still, with respect to governments, right? And, high level governments, I think we're still very early, with respect to, how they're starting to incorporate, right? Like, when you look at Saudi particularly, right? That they have so much cash flow with respect to what they, what they're trying to do. I think it's just, you're still very early with respect to, how they're going to deploy that capital.
Yeah. So the other part of the question was the 15% revenue agreeing to pay that to the United States government for their sales to China. And so I've never really experienced anything like this, and just in my time in the markets. And so it was new to me. But just wanted to get your take on that.
Yeah. So with respect to, to that payment to the government, I think it's a cost of doing business for Nvidia, right? We are in a hyper politicalized space right now. I think the one aspect of it, and this comes back to tariffs as a whole, is how much power do you have to push through that price increase, right? And so I think in Nvidia's case, it's very high. It's actually incredibly high because, they have the ability to, their chips, there's no second best. Intel's not there. Like, no one else is close. So, when we think about those kind of levies, for lack of a better word, for a company like Nvidia, they're going to get their money back, and they're like, that's not going to impact margins in a material way. But bigger picture, we start to get concerned if you do get a real number two, an Nvidia, AMD. Like, if anybody comes in and starts to really, get close to Nvidia's, ability, to be ahead of the pack, that's going to be a real challenge for Nvidia. But we're nowhere close to that right now. They have pricing power. I think in a lot of ways, the right way to look at Nvidia chips is like a commodity, right? So if you like, an Nvidia chip is an absolute commodity, right? So I need this for my AI. Like, there's no second best. I'll need this. Just like I need oil. So if I put a levy on an oil barrel, like, all that happens is that it just, at the pump, it just goes up higher, right? So the person who's consuming that thing, there's no substitute for, will just end up paying a higher price. And then so I think that's where we sit right now until there's an alternative, right? And so that alternative will be a competing chip, that can go head to head with Nvidia's best, and that's just not there today.
Got it. Okay, so pivoting to the resource investment side of the DART ETF. So you mentioned that there's a weighting to gold, and so I want to get your outlook on gold. I also want to get what is the weighting to gold, and what kind of stage development are you looking at investing in with some of the stocks and such? And so just want to get your perspective there.
Yeah. So in the DART ETF, we have a dual position, Bitcoin and gold. We don't own the physicals themselves. We own it through equities because we believe there's fundamental leverage there. On the crypto side, the Bitcoin side, we own Galaxy Digital, and that's worked out well for us. And on the gold side, in particular, we own actually a couple names. We barbell that as well. We believe Kinross is there's value there for us on the larger cap side, but then we also own First Nordic. So, and we're also looking at a lot of other names in the space as well. So for us, like, we think that, that playing the barbell across sectors works as well too at the portfolio level, but when we look at gold in particular, we think there's a unique opportunity there where we just think that you do have this whole small mid-cap space that is, I think, fundamentally undervalued for a lot of structural reasons, which I am happy to get into, and they have to do with the ETF.
Yeah. Share some of those structural reasons. Yeah.
Yeah. So the GDX ETF, the GDXJ, if you were to go back to the last real bull market in gold, those vehicles weren't as prolific as they are today, right? And I think you really have to get into the mind space of how wealth advisors make purchases, right? And so, and like a lot of gold equity investors haven't really appreciated what a meaningful impact these ETFs have on how that plays through for pricing for the underlying, right? And so let me give you let me just play that out for you, right? So these, for lack of a better term, these ETFs are not smart. They're stupid. They're I'm just going to invest in the largest, by market cap weight. This thing's 100 million. That's 1 billion. It'll be 1/10 of that size. You get how that works, right? This is not a very this is not an ETF saying, oh, I think, that's value. It's just letting the market determine the value. But in fact, they're a large player in how the market values it, right? So you got this kind of crazy setup. In the past, you had fund managers that were so you would actually have to have more active money, active management. You'd get fund managers driving the price of the shares, and then you get these passive ETFs piggybacking, saying the market's value here, I'll give you a low cost approach to get there. But now things have turned completely upside down, where the active fund managers, the active money, is a very small component of the overall pie. So you get this situation where you're getting companies in these large cap ETFs that are in our view don't have a ton of value in their current weighting scheme in these ETFs. But then you go back to why do people look to these vehicles as being the preferred way to play, right? And that goes across. We can talk gold, we can talk uranium. This is this is the reality of how money is allocated today, particularly for large wealth managers, where they're listen, we are not in the game of figuring out fund managers, and that's too much work. That's too much work. We're not in the business of even picking stuff. Well, that's not too much work. You are in the business of gathering assets. And that, when I think about the brokers of 20 years ago, these, you would have brokers picking stocks for clients. This was the old school model. That got really drained away. If you, the sausage factory now is very much about, I don't want you to look at stocks. I don't want you to pick managers. I just want you to put it into this, this rainbow or color wheel of ETFs. And you're oh, well then, so then someone will say, well, I don't think these are the best gold stocks in this GDX. Don't care. You want to own gold equities, you got two choices, GLD, GDX. Hey, you want to get a little spicy GDXJ. So you see kind of how this works, right? So what ended up happening is you get this huge dislocation of capital where it's not going to the right value companies, right? And though that, in our view, is a very exciting opportunity because, value dislocations, as tough as it is in the here and now, because you're well, this stock, why isn't this stock up 10x more than Agnico as it probably should be, right? Small caps should be doing far better than the large cap names, right? They Barrick. I don't know, I'm using Agnico as a comp, that's the wrong one. It should be Barrick. These are sleepy, terrible companies you never want to own. But when you buy the GDX, you own a ton of them, right? And so so then the market participant who's not a index, I'm just going to put in GDX and GDX. Well, you get this almost self-fulfilling prophecy. Well, I own like the names in these indexes are doing well, and like my non-index name is not working. Well, this is a function of how the capital is flowing. But as tough as it is in the here and now, these valuation dislocations, they can't go on forever. They absolutely can't, right? And that is that's the opportunity where we really believe that we're in a very unique time where stock pickers, and those that VRIC knows them, this is everyone in the world of commodity investing are in a unique place where everything is on sale. The sticker price is on sale for the things that they would have a unique vantage on, because wealth managers aren't buying those equities today. And I would say that could very well change for a whole host of reasons. But I think if you had to take a real macro view about why we're in a very exciting time, not just for gold, it's across the board, right? I think of the dumb money as the ETF, passive ETF, right? And so, those trends can continue, but the bigger picture is, the value will emerge. There's no question about it. And there's few levers that could take place, but M&A is a clear one, right? If I was a mid-cap, large-cap stock that, has the benefit of being in these indices, get my paper is expensive, I got the flows. Well, I don't have growth. That's one of the challenges in the gold industry. These large cap companies don't have growth. So why shouldn't I take my paper and go buy these value equities, right? And that is one clear lever. And you know how that goes, right? Once that M&A wave starts, then all of these other equities start to move in tandem, and then you get these interesting scenarios where you get investors who traditionally wouldn't be stock pickers in gold equity saying, wait a minute, I own this GDX, but these stocks not in the index have gone up a ton more, and that's exciting.
Yeah, for sure. So pretty much you are looking at, so you're actually getting into the weeds. You're not just buying what's in the GDX just because it's in the GDX. You're actually getting into the weeds of these particular companies. And so for those that don't know, Thomas is always at these mining conferences and such. And so you're on the ground, you're getting to know these companies, you're seeing what's happening in the space. And so could you speak to just some of what are you looking for typically when you're going to these mining conferences and such, and you're meeting with, maybe CEOs of companies, or you're looking at different dynamics happening? What are the things that you're mostly looking for?
Yeah, so for us, gold's a smaller part of our disruptive portfolio, right? Just that, laying that clear, copper, the critical minerals complex is a larger component, which fits in that. But we do follow gold very closely, and the critical metals, complex. We think big picture is that you need a resource that's growing, right? You need a prospective resource. B, you need to know that they have access to capital. And as much as you look at the prices, we're still in a bull market, without having management that can navigate equity raising without diluting investors. This is a critical component. Without being sloppy with the way they raise capital, you learn a ton, right? And so that's critical. And then lastly, they've got to be in a setup where we believe they're in the right jurisdiction. All of these bits have to fit in, and management, I think, at the core of all of it, with the right resource, the right path to production. Whether M&A is along the way, you need the right management in the middle there to really usher that process through. And that's, those are the key pieces, broadly speaking. I think I think, when we look at large caps, we look at them a little differently. But I think the interesting thing is that there's a lot of opportunities right now where you're getting like the value characteristics. Like, so we own Amerigo. It's an interesting copper name. And now, is it the sexiest name in terms of like growth? No, but they have a unique model where they process the ore. They process the water, from the El Teniente mine in Chile, and the largest copper mine. They process the water, so it's like a water treatment facility effectively, and they get copper, and they basically pay out cash flow, right? And so it's an interesting stock there where you can get a high single digit and sometimes low double digit yield. Like, I always think back, I'm like, man, the times where I can pick off mining equity stocks that have clear cash flow coverage for their dividend yield. There's not a time that I don't think back, be like, man, I could have locked in that low double digit, 10, 11% yield, locked it in. Those kind of times I'm like, you just kind of think, you're like, yeah, like, cash flow is so elusive in this industry that when you find a company that has genuine cash flow and then just pays that back to shareholders or returns it through buybacks, you should keep that on your radar as a special company.
Yep. Got it. Yeah. Thanks for sharing that. So what are the other commodities that make up DARP? Obviously the AI data centers was a big narrative and a big, I think it's legitimate as far as like what's going to be needed to drive this AI revolution. And so what other commodities are you looking at? You mentioned natural gas. Are you into uranium? I know we've talked uranium in the past and such. And so just want to get your perspective there on those commodities.
Yes, so natural gas, absolutely. So that, for us, I think that's a real, true undervalued commodity. We've been of the view the equities are always better to play than the commodity, and I really do stress if anyone's like looking at not to dunk on ETFs, but I do like to that don't play any listen. I have issues with the GDXJ, but that's for a sophisticated audience. Like, that's for an audience in the know, like your audience. But definitely, if you're gonna get long natural gas, definitely do not do it vis-a-vis the commodity index ETF, right? Like, that's just not the way. Like, you have a decay. Like, these things don't, like, the equities are how you play natural gas. Like, it's kind of unique in that way, because the truth is, GLB is actually it's a real alternative to playing the miners, but in natural gas, the physical is not. Very different beast, right? Because you're playing through the futures, right? And so very different beast. Like, the number of people that have, I think, a scarred or negative view about natural gas are because they've been messing around with these like futures ETFs and absolutely getting annihilated. So anyways, that's an aside, but yes, natural gas. We love uranium. For us, we own a company called Anfield Energy. They own one of 4 processing mills in America. We have a particular bent on U.S.-based uranium. We think obviously Canada is going to be important, but if you really think about it, the AI revolution is an American revolution, like a lot of technological revolutions. Also China, there's no question about that. But let's address America. The way Donald Trump has set up the industry is really to promote resources that are developed internally. Now, uranium is an interesting one because there is actually, uranium resources in the country, right? Like, when you go through Colorado, like, these are regions that were producing substantially more uranium than they are today. And so, and you're seeing this particularly with MP materials like that. You want to be long critical minerals that are produced in America. there's hands down, you want to be long that, right? I think Trump had he had a quote. I'll pull it, but effectively to that, he was, I'm gonna paraphrase what what his quote was, but basically he's like uranium is as American, nuclear power is as American as it gets, and that to me is a great thing, because it's what I belong, but but bigger picture. Let's even take America away. That's a unique opportunity. We think that that'll, if you produce in America, that'll be great. But I think bigger picture across the world, you can't avoid that nuclear power is going to be an important and growing component of the world that is increasingly powered by from on the vehicle side, and then all of that is data consumption that is going to be powered by the grid.
So I do want to wrap up on this particular point, but this ETF has been launched for a number of years, and you and I we've been having conversations for the last year and a half, and it seems like you all were forward looking in a lot of ways, because think about the companies that you hold. There's big investment from the U.S. government and governments around the world in AI and tech. Chips became a big part of even the tariff discussion. You all own companies that are in that particular field, as well as the data center conversations and the energy needed to produce for AI. That's been in the conversation. It mostly came to light early 2024 from what I remember, when we started getting the big articles on it.
Yeah.
You all were positioned there. Gold, you all were positioned there. And then now you have the United States government has a crypto treasury, and Bitcoin and the crypto crowd has been a big part of that. They did have a super PAC that they were using to fund who was going to be the most crypto friendly president. So just speak to that. Were you all just it's kind of interesting how you all were positioned for almost all of these things that are happening on a macro scale. And so I'm just kind of interested in your perspective on that.
Oh, well, thank you. And I've always enjoyed our conversations, and we've been, we've been talking since, well into, the bulk of when we were running the fund, and you kind of seen it real time. And, for us, we are futurists. There's no question about that. I believe that, you can't have a negative view about technological change, and what, we're believers that it always brings a better outcome for humanity, right? And so once you take that view, then you got to take a broader view that, okay, well, how do I play this? How do I stay ahead of it? For us, we're not. I really try not to stay philosophically bent, right? I try not to be we are of the world of hard money, but we believe that it's a continuum of Bitcoin to gold. So we try not to have this theology around things, right? It's this or that, because I think when you find that you get very black and white about things, that's when we could have been very black and white about the combustion car engine, or let's be frank, there's a lot of people that are, and that puts you really into a corner where you're a lot of my very dear friends are commodity energy investors, particularly, they've missed out on massive opportunities because of their very ardent view that there's no substitute to oil, and this is the way, and and it just kind of, you get into this self-fulfilling loop, and we're both on X, and it's just so easy to to limit your to put the blinders on in anything, right? And the same goes for Tesla. The flip side is Tesla. We've never owned Tesla in size. We've owned it here and there, but we don't own it in size compared to our peers. Our view is that it's at least since we've launched the ETF, the competition has been incredibly fierce. I'm always kind of blown away whenever I see these Chinese EVs. They're incredible. Like, they're functionally incredible. And, Elon had an incredible window and that's past, but the main part about it is staying fluid in your view, keep looking ahead. We continue to reassess our thesis every day to like what could derail everything we're doing right now. But we continue to, and we don't get fully ardent, right? Like, we'd like prior to the launch of the fund, there were a lot of trends that came, and the critical thing is that we're growth investors. I'm going to get a lot of things wrong. I got to get the things right, but I got to do that in size, right? So the way I think about it is, so being a disruptive growth investor, you're going to get things wrong. Like, you kind of got to put that aside. You got to accept it. And but the other side of it is you're running a portfolio strategy. And the key thing about it is once you notice that the growth is gone or, something has fundamentally changed, you have to be fast. You have to be quick to reduce your exposure and reassess. That's where most investors fail, right? It's not about putting the position on. That's the easy part. It's taking the position off. That's the hardest part, man, because that's admitting that you're wrong. And and it's not like, and then again, that almost loops back to this very, when you have fundamental views, you're like, well, I can't be wrong because, the gas, clearly, oil is a superior fuel to, a battery. And once you kind of get into these self-fulfilling loops, that's how you own dead assets, right? And we covered cannabis in the early days. We absolutely did. But then, when it was clear that the best was behind us, we exited. Like, we just said, we know these names better than anyone.
You got out of Tilray.
Yeah, we got out of right. Like, we were just like, there just was nothing there, right? And what you don't want is when you're faced with data, right? And maybe something to the cannabis, if any lingering cannabis investors, and listen, there's a lot of the MSOS ETF is up, it's up a lot in the last 3 months, but if you take a bigger picture, it's not so pretty. But for us, but for us, and kind of like a grounding, and my partner Scott is great. Just kind of how we think about things. It's just it's just the fundamental profitability of these businesses is just not there, right? And that, I think, one example is, if this was such a great business, genuine and great business, you've got a fully legalized market in Canada. Why are these companies sucking? They just can't even win in Canada. And when you realize that once you get, the myth of, well, I'm going to be the Marlboro man of cannabis or whatever, right? There's always some sort of, I'm going to be this or that. Well, there is potentially that hope, and maybe it happens, but then the reality and the vision sometimes doesn't match, and you got to exit. The bigger picture there was, well, what ended up happening was that, the black market didn't go away. Those dealers still stayed, and now they don't go to jail. So, your competitive landscape hasn't dramatically changed, but now you got two hands behind your back, and so anyone who, California is a great microcosm, because in a lot of ways it's kind of like Canada, right? In terms of, where it sits with respect to cannabis and, the how deep it is in the economy. I just think that, if we haven't had a leader come out of California, you could say everything about these Canadian companies, but if you haven't had a leader come out of California, it's going to be tough to vision a world for cannabis. But again, I'm just kind of digressing here, but that's kind of the way we think about growth industries, where you're like, yeah, there was an opportunity. And so for us, we were like, hey, listen, the U.S. cannabis stocks are probably the ones you want to own. But I think there was a golden window there where you needed legalization to happen. maybe early Biden term, right? Like that kind of, you needed that to happen. And, he kind of sleptwalked through his whole term, lack of a better, for, yeah. So it never happened, and now the views like maybe can happen with Trump, but anyways, but the bigger picture is that if the underlying data is proving your thesis wrong, listen to the data and reassess your thesis. That's really it, right? And always be willing to have humble pie. I eat a lot of it, and I'm okay with that because like the bigger picture is. Like the two pieces are, you can put a position, you can always put a position on, but taking one off is very hard. But you can always put a position on, but if it's not in size, well, what's the point? And that's how we come through every day. We have a position on, is it the right position? That's point one. We have a position on, is it the right size? And that's really where we won with AI. We had Nvidia, we were the ETF with the largest weighting in Nvidia in the disruptive space. Like that was a massive win for us because we're like, was it the right size? And every day we were like, it's got to be bigger. And so, but again, it can be smaller too, but you kind of have to assess those two things every day, right? And that's why I think active management really is superior, bigger picture to passive. And I think we've just come out this massive way. Well, we'll put it in SPY and you'll be fine, blah, blah. And I just think, we're nearly 4 years significantly outperforming SPY, significantly outperforming the NASDAQ. And I know that's just saying that I don't need to own everything of everything. I just want to own the best I can own. And that's in a backdrop of some of our commodities not working while some did, right? And so that's totally fine.
But I mean, in the broad scheme of things, and sorry to anybody who may have virgin ears, we were talking about pot stocks for a little bit, but so in the broader scheme of things, I mean, over the last year, 35% return on the DART ETF, and then over the 3 years, I mean, you had about a 20% return. And thinking about those 3 years, I mean, many of the gold stocks were in the dump. Many of some of the commodities weren't really moving as much and such. And so to think about, you got 20% in those years where the commodities weren't really doing very well. There was a lot of pain. There was concerns about recession. There was concerns about, can we get the capital that we need, all of that. And so having that barbell approach, you all were able to perform during that time as well. And so I just wanted to highlight that. So as we wrap up, where can people, connect with you? Where can people learn more about the research that you all are doing so that they can stay ahead of the game?
Yeah, Darrell. Well, thank you first of all, foremost. Always a great conversation, and it's always whenever we chat, it's like it's always great. We touch every plane of the map, and so for us, in terms of our broad musings, the two wonderful partners, Scott Willis and Chris Wood. Chris Wood's an OG. He's the chief equity strategist at Jefferies, and we are very fortunate to have him as a partner for Grizzle since day one. You can get his research. He writes for us weekly at research.grizzle.com. And our musings as well. So that's all there at research.grizzle.com. And then if you want more information on the ETF, it's etf.grizzle.com. Get it there. Well, we have a white paper that we'll have officially released on there that we've had out in the open to investment advisors, but we're just getting it cleared through compliance for mass consumption. So that'll give you a real understanding of our thesis and how we think about things. And those are the two key pieces. And then obviously we're always cutting it up on X, right? And which I think is one of the places where stocks really live and die. It's conversations for security is always there. And so that's those are the places you can find more info about us. And as you said, we're always at conferences, and we actually have we do a virtual hard money conference, which is that's been a great, we were kind of built, we put together the pieces of great great thinkers in both the Bitcoin and the gold space, and that's kind of been an anchor for what we do. Like just in terms of staying very philosophically open, but still committed to knowing that money printing is here and everywhere forever. And I think that if I could leave like with one comment is that what's clear is that there's two solutions to where we sit right now in an over-indebted society, broad strokes, developed nations. You can take the bitter pill and take austerity as a whole. And if you want to have the backstory on how austerity works, look at what happened to Greece. There's great examples of how that's not a great, it's tough. It's a tough road. Or you inflate it all the way. And if you have governments that can last for decades, and the Western world is not built like that, China is. You're always thinking about 2 years out. Like, how am I going to do in my midterms? I'm going to do it at the general elections, whatever it is. You're like, it's always you're going to take the sugar rush, and I think that just bodes really well for having hard money commodity in broad commodities in your portfolio.
Mm-hmm. Yeah, got it. Appreciate that. Well, you all be sure to go check out research.grizzle.com as well as etf.grizzle.com if this conversation interests you. Thomas, appreciate you coming on the show.
Always a pleasure, man. Thank you.
All right, you all, and be sure to hit the subscribe button. Love to have your support, and thank you for watching.